the real estate crash that we're currently in is way more comparable to the 70s and 80s than it is to 2008, and we're going to break down why. But it's also the beginning of the month of October, which means we have all of September's numbers out, which is usually when fall starts. Numbers start to decline a little bit. We start to get into that fall wintry feel, but we're going to take a look at every category across the Denver metro real estate market, let you know what is going on so you can make informed decisions. Now, I like to just jump right into it. So we're going to cover the big elephant in the room right now, which is interest rates. Look at these current interest rates. So I love to use Optimal Blue. They're just my favorite way to track the daily happenings on mortgage rates, and I'll have the link in the description below too for you so you can follow along with it. But what we have here are the three most common loan types, which are going to be your traditional conforming, 5% down conventional loan, FHA, which usually requires about 3.5% down, depending, which has a little bit better rate. And then we've got the jumbo, the monster loan product that is as expensive as you can get pretty much on a loan other than having a car or a credit card. So just looking at the most common, let's look at the conforming. This is over the last 3 months. I mean, it's just been through the roof. Today, we are sitting at 7.483. The last time we were at this number, let's take a look. December of the year 2000, 23-year highs on mortgage rates. So that's been the driving factor of all the headlines out there. But you know what? Most things have held up extremely well, which is a little bit of a surprise. The Fed out there, they really only have two jobs, and that's to ensure maximum employment and keep inflation towards their target goal of 2%. Well, they've had max employment, and darn it, that is running everything. They haven't broken anything in the system yet, so I do think they're just going to keep raising rates until something breaks. Now, we're going to take a look at what's going on in the Denver market specifically, because I know that's what you're interested in, to find out, is it a good time to buy? Is it time to take advantage of the fall winter markets? Or is it still a good time to sell because, not many people are selling and as many houses are being bought as are being sold? And then we're going to compare what's going on now to what happened in the 70s and 80s when interest rates were over 15%. Because we have a track record of this, but yet everybody's telling us that real estate prices are going to plummet. Well, last time we had a hike in interest rates like this, sorry to break it to you, but real estate did not decrease in value. But we're going to look at all those charts. So let's just get right into it and start with the Denver numbers. What we're looking at here is a 3-year chart. We always start out with the closed price. We start out with median. I don't really use average price because it's not as good of an indicator, but August, we were at 565. As you know, April of 2022, 600 was the peak, went all the way down to 520 in an 8-month period, 15% drop in about an 8-month period. Then we went all the way up to 575. So 12% gain. We made it almost all the way back. And then we're dipping a little bit in August, but from August, we were at 565.8 for the median sales price in the entire Front Range of Colorado. And that went up to 568. So we went up a little bit in September, which is not very common. We can go back and look. We got August, September was flat in 2019, 2020. That year. Let's just go back even further and take a peek and see. We've got June as the peak in 2016, and then it just keeps kind of sliding and goes flat for a few months, almost every single year. So yeah, the fact that we went up in September is a little bit interesting. Not gonna lie. So that's on our close price. So we haven't just dropped off the map. That's the biggest number that everyone wants to see. If you want to turn this video off now, then you're going to miss the best part of it. So I would suggest not doing that. New listings. This is what's driving the hold of prices and why we're just not plummeting. And that listings are down. So we were at 7,700 new listings that hit the market in August. We went down all the way to 6,900. So 10-15% drop in 1 month on new listings hitting the market. Now, that is not abnormal. We can go back and look, last year, June was the peak of new listings to hit the market, and then we just fall off a map with new listings hitting the market. So this is very cyclical, not out of the ordinary. But we can see the amount of new listings to hit the market in September as being just under 7,000. When was the last time we had that few listings hit the market? 2016. So 7 years ago was the last time we had this few new listings to come to the market. And you can just see, this is, the amount of new stuff coming onto the market. And then boom, we fall off the map. Interest rates go up. Everybody that would be a seller that also has to buy has a very difficult decision on their plate right now, and a lot of them are deciding to stay put. Okay. Active listings. So what we saw here over September is that the amount of active listings dropped, meaning there were more buyers than there were sellers for the month of September. Now, it's not much. It's nominal by a few hundred, but that's what's happened. Pending listings. Okay, so this is where we can start to project what's going to happen over the next 30 days. And we can see from August we had 5,800 under contract down to 5,200. So over the next 30 days, I would expect there to be somewhere around 5,200 closings, which on average take about 30 days to complete. Okay, so falling off a map, is that normal? Yep, absolutely. Year after year, happens every single year. We start dropping off on the amount of pendings that we have. Closed listings. Here's the big one. Here is the silver bullet. Here is the number that, quite frankly, is putting a lot of people out of business. So I've talked about this in the past a little bit, but if you're not in the real estate business, there's a lot of ancillary businesses that, of course, run off of real estate. Photography companies, staging companies, listing services, transaction coordinators, title companies, and that's in addition to real estate agents and lenders. Well, when transactions fall off a map, we have a thinning of the herd. Just a couple years ago, real estate was an extremely sexy thing to be, and it was fun, and, anybody can do it. And now we have headwinds. I have several on the market right now, and more than half of my day is just spent in communicating with would-be buyers, potential buyers, buyers agents showing the properties, in trying to drum up, hey, the interest, get the offer in, work together, negotiating, where 2 years ago, you put something on the MLS, you get offers at 30, 40, 50 grand over. If someone doesn't like something, you tell them to go scratch next, and then you sell the property. You were in full control as the seller. But now we got to work with the buyers on inspection items and really getting on the same page and doing our job. It's no longer fun. But right now it's a lot of a grind. And I would say that on average, I at least am working about 4 times harder for the same amount of pay, right? I know, oh, woe is me, boo-hoo. No, I have lived a very blessed life. I live a very good life that I can wake up every single morning and choose what I want to do. I can choose who I want to talk to. I sacrificed having one boss in the corporate world to having, hundreds of bosses being my clients, right? I love what I do. I could never, not do this, I don't believe. But in general, yeah, when it's time to wake up and grind, a lot of people exit the business. And I actually have a friend that sells services to real estate agents, right? Lead service. And I believe her. She gets very, very close with her clients because she's a phenomenal person. And she was reaching out to her clients, us agents, the other day. And she said that 50% of the agents she had talked to had a full-time gig. Okay? Let that sink in for a second. She has hundreds of clients, I think she talked to 40 real estate agents that day, and said that half of them had a full-time gig, full-time job, and was now doing real estate on the side with the limited number of clients they had. So this is the reality of what's going on there, folks. Now, back to the numbers. Now, next, after closed listings, which let's take a look. We closed 5,100 in September. Let's zoom this chart out. When was the last time we closed 5,100 in September? Wow, we got to go back to 2012. Okay, so here's something really fascinating, is that when we talk about 2008, right, and the last crash that happened, um, we talk about the year 2008. But it took us 4 years to rebound from that, Cat. So 2007, things started to get funky. 2008, shit really hit the fan. Everything just went splat. Well, it took 2 years of a declining market from '08 to 2010 of going down. Then we were flat for another year before we started climbing up in 2012. But in 2012, we didn't know that that was the bottom. It was still a pretty scary time. And so it's been 11 years since we've had that few of closings. It was back in 2012, which things were still really, really depressed out there. That is interesting. Now, let's get on to the other numbers. Days in MLS. And as we know, days in MLS is just starting to spike. We're up to 17 here in September. Last year, what was it? Woo! We matched last year. Holy cow. So we might feel what happened last year, which was a 10 to 15% reduction, depending on your neighborhood. Zooming this out, now you can see every single year we have a spike in days on market, but the last couple of years, it's just been, or last year I should say, it's been quite a bit more. Month supply of inventory. Month supply of inventory is flat. 2.5 months of inventory for the last 3 months. Sellers balancing with the number of buyers out there. Not many buyers, but also not many sellers. Shows to pending. Wow, so this number dropped to 8 from 9, meaning it takes 8 showings on average to go under contract, meaning there's not as many buyers out there, but the buyers who are going to look at your house on the market are serious. Showings per listing has dropped down to 4.8. So if you're getting 4.8 showings on your listing per month, then it's going to take 6 to 7 weeks on average to sell. That's what this number is telling me. Okay, so there we have it. Closed prices are still solid throughout the Denver metro area. Now, something I do want to show you that we really don't track much, which I started to last year actually. Something that you guys don't see, Redfin's data center has this number, but every morning I log in. This is the MLS, okay? And I see the amount of new listings that have hit the market, and this is in the last 7 days, okay? The amount of coming soon in the last 7 days. So just these numbers, 1,471 new listings in the last 7 days, 184 coming soon, 364 back on the market, so meaning they were under contract, then they fell out of contract for inspection, appraisal, financing, whatever. They went back on the market. 108 with price increases, which is usually just a marketing tactic to get it in front of everybody's eyeballs again. Price decreases, kaboom! 1,986. So there have been more price decreases than properties coming on the market. How many active listings are on the market? So we have 13,211 compared to last month, 13,584. So 13,211 divided by, where'd it go? 13,284 divided by 1,986. So what is that? 15, not quite 15%. Properties are having price reductions right now, which a fascinating place to go visit and see that. If you've never checked it out, Redfin's data center. So if you're staying up to date with what the market is doing, you can come down here and you can look at the price drops in any markets that you want to. And we could see last year, we're going to pick on Seattle here, which is in orange. 50% of the properties basically had a price drop last year. That was an abnormal year, although previous years they get pretty high. And so we're starting to see that effect again. I expect the same thing to happen this year that happened last year approximately, with price drops and with price decreases on average across the board in most real estate markets in the country. Now, let's get on to why, first of all, this is a real estate crash. Because it's not a crash in terms of, everybody losing their house to the banks. And in fact, we actually have fewer delinquencies and foreclosures than we've ever had because our debt to value ratio is so out of whack, meaning in a good way that we don't owe nearly as much on homes today that we did back in 2008, which is part of the reason that led to the crash that happened out there. Now, what we have is a crash of home sales. Okay. We have a crash of the amount of homes that are being purchased. And, to take this back to 2008, we're not in the same situation. Back in 2008, we had, at least in the Denver metro area, we had about 45,000 homes on the market before the crash started. So inventory kept rising, but you could buy multiple homes without proof of income and, writing mortgages in your dog's name and crap like that. But that's not the thing anymore. They've tightened up on their lending restrictions, and so we don't have that sort of bubble in effect. And when we had 45,000 units on the market in the Denver metro area, the bottom fell out of the real estate market, and we were selling 5,000 homes a month and less, which is matching what we're doing today. However, there was 4 to 5 times more inventory on the market at that time. So right now, I just showed you, we had 2.5 months of inventory on the market. Well, back in 2008, that was more like 9 to 12 months of inventory on the market. It took forever to sell, and you just kept doing price drops until you hit, your lucky day. And then you got under contract and the buyer beat you up for everything under the sun. But what we're experiencing now is actually more like the 70s and 80s. And I want to show you something here. So if we rewind the clock and we go back to looking at interest rates, okay, so we're at 7.5% today, essentially, just for easy numbers. And we can go back and we can see in the late 90s, we were at 7%, 8%, 9%, but all the way back, let's go to the 70s, right? I'm looking here at 1973, we're at 8.6%. And then boom, we spiked up all the way to 10% in the end of 1974, okay? Then let's go look at the 80s. So the very beginning of 1980, January 25th, interest rates were at 12.89%. By the time 1981, the end of that year kicked in, we were at 18.3%. Can you imagine what an 18.3% interest rate would be like on a mortgage? That would be absolute insanity. But if we're on that path, we're already starting to show signs of it. 10% would be a tough nut to swallow, let alone 18%. And here's what happened in correlation to real estate prices. So let's take a look at 1980s because it's an easier number. So 1980, 13.6% in the beginning, all the way up to 18.4% by the end of 1981. So basically a 2-year time span, okay? What did real estate prices do in that time period? Let's go ahead and look. The quarter one of 1980, the median sales price in the U.S. was $63,700, if you can believe it or not. That's what it was. By the end of 1981, $71,600. So we appreciated 10%? Yeah, 10% or more in that 2-year period when interest rates were at 18%. Okay? That's what's fascinating to me. And, the same thing happened then that is happening now, is that you want to downsize, right? Maybe you're a baby boomer and you've got too much house. You got a 3,500 square foot house, 4 bedrooms, 3 baths, and even cleaning it is just a nightmare. And maybe your master bedroom, your primary bedroom, is upstairs. And now you don't want to do stairs as much anymore. So what you would normally do is put your house on the market to sell, look for a single-story ranch home that was the same amount of money or less, and get a house that's 1,500 square feet or smaller, right? But now, if you have a mortgage in place, even for $300,000, and you're paying $1,600 a month, $1,800 a month, and you want to take out that same exact mortgage, $300,000 for a new house, well, that new payment's going to be $3,200 a month. Who in the world wants to make that decision? It's extremely difficult to swallow that pill to go from $1,600 a month payment up to $3,200 a month payment, even for a smaller house. So we virtually eliminated all of those sellers and all of those buyers from the market. And it just escalates, A handful of years ago, I think when I started this business back in 2012, 2010 maybe, that the average time that someone lived in a home was 7 years, right? Well, now that number is increasing. I think we're getting up towards 10 years before buying and selling a home. It used to be 5 years before I entered this business. But that number keeps increasing, which means there are less transactions happening. There are less people putting their house on the market. And so long as there are less people putting their house on the market, prices are going to remain stable. So the indicator to look for is an increase of inventory from somewhere. It could happen one of two ways. Either one of these big firms, BlackRock, Vanguard, State Street, whatever, decide to dump all of their rental properties, which is never going to happen. They don't get squeezed out of the market like we do, folks. Doesn't happen. They are the ones with all the money. They're the ones who make all the rules. So if they even did start to get squeezed, then they're going to have politicians change rules to benefit them. Or it could come from just the sheer number of closings continuing to decline. Okay, so let's say in a few months we have 2,500 sales being reported. We're over 5,000 now. Well, you're still going to have more properties coming to the market, and then you could have an imbalance of, hey, maybe we've got 5 months of inventory now. And with interest rates, we have so few closings that you have to try harder and harder as the seller by either decreasing the price, improving the property, and ultimately at the end of the day, making less money on your home sale. But that's not in the cards either right now. So here's my 2 cents and my crystal ball, and what it's saying is that we likely see something similar to last year, except less extreme. Last year we had a 15% drop. I think we have anywhere from an 8 to 10% drop in prices on the median price in the Denver metro area till about January or so. And then if interest rates don't go above 10%, I think we see prices increase 5 to 10% from about the end of January until about the middle of May. So I think it's just a cyclical thing with less transactions and a bigger need to navigate that sale or purchase a little bit more carefully, right? And because my fear ultimately is that if interest rates plummet down to 5%, let's say in the next month because something breaks, which is very unlikely, but let's just pretend that it happened. Everybody who was waiting to be a seller to buy what they wanted to buy would come off the sidelines, would flood the market with more inventory, but would flood the market with even more purchases, and I think home prices would skyrocket away from what would be a first-time home buyer in today's market. And I think within a couple of years, I think it would be unattainable for first-time home buyers. So unless your parents owned a house that got handed down to you, I think it would start to be a real struggle. So I'd love to hear from you. Feel free, drop a comment below. You've got my phone number here. Give me a call, shoot me a text message. I love talking about this stuff. I do it all day, every day. And hopefully this has been a little bit of insight to help you on whatever your real estate goals may be. And until the next time, happy housing.